is not high. It's like a great many of the indicators that you'll see in the book today. They're contrary indicators. When people are most optimistic, the performance often is not good. Conversely, when they're most pessimistic, the performance is often very good. And you can see, and you will see on a succession of these graphs, that you'll find a performance box here, usually broken into 2, 3, or 4 modes with various statistics. And you can see, at least in your booklets, I think, the one that's darkened a bit, and that shows you the, in this case, it's the bottom category, when it shows you what the forecastability, let's say, is of stock market performance when whatever the study is in that particular mode. So this is one of a great many contrary indicator studies that show when consumer confidence is low, stock market performance is often better than average. This is a quick overview of current economic conditions. Now let's turn our attention to the stock market, or the markets. Start with stock side. Longer term stock market picture, tremendous rallies over the past year for almost all stocks. You see, certainly we have the Standard & Poor's 500 up here at the top. This is roughly a 12-month rally, a very dramatic rally. Likewise for NASDAQ, the NASDAQ composite down here, just about a 12-month rally, a very dramatic rally as well. In fact, the S&P is about a 75% rally from the very low back in March a year ago, although it's still down about 25% from the prior high. It's back to levels, as you can see, just drawing a line across, back to levels about where it was 11 or 12 years ago in 1998, 99. And the same is true with slightly different numbers for the NASDAQ. We've had about a 90% rally in the NASDAQ off this bottom, and yet that is still more than 50% below where the NASDAQ peaked back in year 2000, and it also is just about at the same level as it was 11, 12 years ago in the late 1990s. In a great many of the seminars and conferences that we've put on here over the last decade and a half almost now, we've discussed our study of long cycles, long strong cycles and long weak cycles and so on, and I'm not including that in the booklet tonight because most of you who've been here before have seen that study, and there's no appreciable change in it at this stage, so there's not much purpose in resubmitting it. For those that are new and you want to see the study, just let us know and we'll be happy to send it along to you. On average, most of those long cycles, whether they're the weak cycles or the strong cycles, have lasted about a decade and a half. That's been typical. Some longer, some shorter, and so on. This current long weak cycle started right about up here in year 2000. So it's just about a decade long now. And as Susan pointed out, that decade, by the way, which didn't start right at the peak, it started a little before the peak, but the total return for the S&P was about down 0.9% of 1% annualized on a total return basis, which the S&P, or the Wall Street Journal rather, said was the worst decade in U.S. history. Very interesting. It was even worse than the decade of the 1930s because you had a pretty good rally at the end of the 1930s, into at least 1937, and then the decline continued off to 1942. But at least for the decade as a whole, it was slightly better than the decade of the aughts, as it were. But one of the things we learned from an examination of all of the long weak cycles of the last 100+ years is, and we did this at one of our conferences back several years ago, I've forgotten which one, is that in all of those weak cycles, none of them ended until the enthusiasm for ownership of common stocks was completely wrung out. Now that didn't happen in this instance, which may either indicate that it's different this time if this has marked the bottom of the long week cycle. Or if this hasn't marked the bottom of the long week cycle, maybe we still have to do some more downside at some point over the next few years potentially to wring out that enthusiasm that still exists for common stock ownership. And it surprised me, frankly, a little bit that the enthusiasm for stock ownership, at least on the institutional side, has come back as quickly as it has in this instance. If you look over to the next page, you'll see one of the reasons I'm a little surprised by this. This is a picture of quite a number of years, stretching from 1952 to present, and it shows the great bull market up to the peak here at the end of the 60s, and then we saw a big decline in 69, 70, big run up to the end of 72, the ultimate crash down to the bottom in 1974, and then 74 was the end of the stock market decline. But interestingly enough, and this is a graph that shows the percentage of household assets that were held in common stocks. And there's a whole series of these graphs that shows institutions as well as individuals, it shows mutual funds and so on. They all have the same pattern. This one is the most descriptive, and so it's the reason that I'm showing it, but the pattern is the same for all of them. The interesting phenomenon is that though the stock market bottomed here, the enthusiasm to get back into stocks wasn't rekindled for almost 20 years. I mean, you didn't really get appreciably above that level, and in fact, even though stocks were going up, you saw stock ownership by households continue to decline for some period yet. And this is 20 years or so later, in the mid-90s, that stock enthusiasm grew again. And we see, of course, how this is around 2000, where the first big stock market decline began. It obviously hit terribly. We had some rebound here, and then we went through the 07 to 09 decline, and we've seen a fairly quick bounce back here. We're still at very high levels relative to where we were before. Well, that may be an indicative of it being different this time, or maybe not. Maybe the cycle hasn't ended, and maybe we will yet end up in a dislike of common stocks. That's something that the future will have to show us. But let's start looking at the current stock market technical situation. Look first at this is a daily graph of the S&P 500. This is from Decision Point. And this covers about 13 months of data. This shows this shows the March bottom a year ago, and then an almost uninterrupted rise. You've got a small decline there, even smaller decline there, relatively small decline January, February, and now we've gone back up to a new high. This was as of Monday's almost close, and the markets went up again yesterday, down today. So this is one of the biggest 12-month rallies ever. The trend is obviously terrific, and all the moving averages, which are shown on this graph, you see three of them. This longest is the 200-day. This is an exponential moving average, which is only slightly different from an arithmetic moving average. Don't worry about the distinction. And then we have a 50-day moving average and a 20-day moving average. All of these are rising, and the stock price is above all of them, which is generally a very positive position for prices. And all else equal, the safest bet when you see that is bet for a continuation of the current move, the current direction. We see a couple of